Okay, so here is the statement of returns. Now, what happened in this thing is, so this is the statement of retained, this is a statement of retained earnings. So what happens on this thing is, the statement of retained earnings is part of is part of the move toward comprehensive income. And so what this does is the income statement and the balance sheet, there really should be more of an explanation than that. And so the statement of retained earnings is one of that movement, so that what it is so things are more disclosed. So in this case, the way it starts out is, here's the retained earnings at the beginning of the accounting period. Here are the changes. Here's how it ends at the end. Okay? So in this case, it started out at $850,000. Then it was increased by the net income, decreased by the dividends. Now these are declared because once they're declared, they become a liability, right? But they're going to be paid sometime in the future. So at this point, it's dividends declared. Once they paid, it'll of course be dividends. Then here's the returnings as of the end. It also discloses that some of these retained earnings you have to keep. We're going to keep them in our corporation. And of course, what happens is sometimes it's voluntary. In other words, we're planning to have a building, and we're saving toward the building, and we're not going to give that out in dividends. Sometimes you have to, like it would be a loan agreement, says you've got to keep a certain amount in the business. So it can be a loan, it can be voluntary. And then this is the amount that's unappropriate. So we could give this back in dividends if we wanted to. Okay? So this is the statement of retained earnings. Here's another statement of retained earnings. I mean, this one, I think this is the statement of retained earnings. Now on this one, what happens here is they discover, so again it starts, here's what it was, retained earnings previously reported. Now they discovered an error last year, an error on the income statement, right? So what they do is, here's where they make the correction. So prior period adjustment, that means they made an error they discovered. Cost of equipment incorrectly expensed, net of $28,000. So it was really like $100,000 error, but $28,000 in taxes. Okay. So what it is, there's $100,000 error. Paid, increase their tax liability by $28,000, so the net is $72,000. So here's the adjusted retained earnings, add the net income, subtract the dividend. Here's the retained earnings at the end. So basically what happens here is, when you discover an error in a previous accounting period, this is where you disclose it and the ramifications. Okay? And again, this is part of that move toward comprehensive income. You have statements that disclose more than just the income statement and the balance sheet. All right. Here's the stockholders' equity section. Now, is this one you had a question?
Yeah, that's what I had.
Okay.
Before we move on to that, something on the homework that I noticed with the statement of retained earnings.
Okay.
It said less dividends declared, but then there was also another thing that had to be subtracted.
Let's take a look here.
That came out of retained earnings.
Are we doing, okay, good. And this was, what problem is it?
That was 13.2A.
13.2.8. Let's just put this up. And which one specifically was,
That was part 2.
part 2.
Statement of retained
Okay.
earnings.
Let's put it up here. So here's the statement of retained earnings.
Right there, treasury
Okay.
stock wage.
Let me make this large.
There we go, that's how we would
All
put
right.
it. Okay. That was, I just wanted to see how you would put that in, because it
Okay.
said less cash dividends, that you had to subtract the cash dividends, but it didn't say anything about the extra. And to reconcile, there was that difference with the other one. And I wasn't quite sure how you put that, so that's.
Okay.
That's it.
Okay.
Yeah, I just wasn't sure how you would record that in there. I just put it in as, retained earnings debit. That-
And of course, this is a debit retained. Yeah.
Yeah, it was a debit to retained earnings, okay, so
Mhm.
I wasn't sure how you would put that in, so that, thank you.
And again, it's the same sort of thing. The statement of retained earnings, it just discloses more than the normal income statement would.
It's what goes in, what comes out.
So here's the statement of, okay, so,
Stockholder equity is the other one.
okay. And the stock, okay, in this case, again, what it is the statement of stockholders' equity. Now, on this particular one, what it has is, you have the beginning, you have the ending, and here are the changes. So So in this case, the balance as of the end of last year, which is the beginning of this year, there were 821, and this of course is thousands or millions or whatever, but it's numbered in that. Here's 250,000, retained earnings was this, the total is that. They sold 17 shares, here's the amount, was that? Okay, and it'd be 17,000 or whatever, okay? And then that would increase the total. Then they repurchased and retired 17. So what it is then they repurchased, retired.
So treasury stock would go there.
Treasury stock, yeah. Well, when they repurchase and then retire, so it'd be treasury stock, and then they wrote everything off, okay? And so this is the amount that came out of the paid-in capital, okay? Common stock in excess of part of the paid-in capital. This is the return earnings, you know, when they retired it, and so this is the amount that the equity section decreased.
Okay.
So, okay, here's cash dividends declared, okay? Of course, the cash dividends come out of retained earnings, okay? Other net, something that comes out of the retained earnings. Here's the net income, that's an increase. So the shares went up by 17, down by 17, it ended up being the same. The paid-in capital started out at 2,500, went up by 500, went down by 260. Retained earnings increases, decreases at the end, and then the total stockholders' equity changed accordingly. And again, this is part of that comprehensive income, because these statements disclose things that aren't disclosed elsewhere and disclosed in a way that's supposed to make them obvious. Okay? And the reason this came about is too many things just didn't show up in the standard financial statements that needed to be disclosed. So,
So the numbers were
that's,
adding up, but they
what's
weren't-
that?
So the numbers were adding up, but it wasn't clear where.
Exactly. And the other side is people were hiding too many things. Okay, I mean, it's true.
No, I-
So now, what they do is they have all of these statements, so there's no reason why anything shouldn't be disclosed. Yeah.
Can you explain what the cash dividend declared is again?
Well, what happens in this thing is when they declare a cash dividend, it becomes a liability because they owe the money. So the reason it's declared is between when they declare it and when they actually pay it. So they haven't paid it yet. So they declared it, that's why, and they owe it, but they'll pay it sometime after after December 31st, 2011.
So they subtract this.
Yeah, just because once it's declared, then it becomes a liability.
Oh, I see. Okay.
And so, and of course, yeah.
And
What's the difference between that amount number and the retained earning numbers? What are those two numbers?
Okay, I'm sorry, let's see, the amount.
2,500 and 9,500.
Oh, this one? Oh, this was called contributed capital. In other words, common stock is how much, you know, when these people issued shares, a certain amount went into the common stock account, legal capital, the amount above that went into capital excessive par. That's called paid-in capital, contributed capital. So the contributed capital is 2,500. Now there's bound to be at least three more zeros in the end of this, okay? And then retained earnings. This represents profit that's been left in business since its very beginning. Because retained earnings, it'll increase by net income, decrease by net loss, decrease by dividends. Okay? And so this is the profit. This is how much people paid into the corporation. Next topic. So let's take a look at stock options. Okay. Now what stock options do is you give somebody the right to buy shares of stock at a certain price sometime in the future. That's a stock option. And basically what you want to do on that is you hopefully will turn your employees, your employees will start acting like owners. So what they do, because you want them to focus on performance, so a stock option, okay, and again, then what you want to do, you hope they take a long-term perspective, you hope they remain with the company, you hope they focus on company performance because you want them to start acting like owners, okay? And we also mentioned that a lot of startups several years ago got these geniuses that they never could have afforded otherwise, but they said, listen, you want to be a millionaire? If we pull this off, you're a millionaire. You can you buy the stock at such and such. And of course, they can buy it at a guaranteed price. And if its market value was greater than that, they turn around and sell it at the higher price. The difference, of course, is their profit. Okay. All right, let's take a look. Now, by the way, be sure to know these ratios, because these ratios are very likely to show up in the test, which is a good reason to know, right? Because in the past, I just wanted you guys to know that, because in the past we had the ratios in every chapter, and then you never saw them again. So you may think, don't bother to study them. Never mind. All right. And the things, I don't work that way. I know it all, right? Okay, well, I just fair warning you guys, just be sure to know these ratios. All right, one is earnings per share. Okay, and basically, the basic earnings per share equals net income minus preferred dividends divided by weighted average common shares outstanding. Okay.
How do you get the weighted average?
Well, what it is, yeah, the way that works is, generally it's by month. Who asked that question? Was that you?
That was me.
That was you. Yeah, what you do is, it's the number of shares outstanding by the months that they were outstanding. So, you take like, and you just wait, and you just,
So you just add up each month together and divide by the number of months?
Exactly. And then give you a per month average. All right. Yeah.
Sorry, what is the last two words of the basic earning something?
Okay.
Very
Per
beginning.
share.
Per share? Okay.
Mhm.
Sure.
Now, the thing about it is this is one of the most quoted ratios that you see, is the earnings per share. And so it's just the earnings per share is one of the most quoted that you see, okay? And it's just the earnings per share. The trouble with it is even though people somehow put a lot of stock in it, it's easily manipulated. So if you wanted to raise your earnings per share, then buy stock back, okay? And, you have more treasury stock. And of course, that means you'd have a lower average. You'd have a smaller denominator. So anyway, let me do exercise 13.2. You may find that on page 539. So let me do this. I'm going to toward the front. Okay. Exercise 13. Yeah, I said, okay.
The 1312?
Yeah, exercise 13.12. Did I say 13.13?
13.2.
Oh, 13.2. Oh, it's 13. It is 12. Okay. Right. Okay. So let me put it over here. So it's 13.12. The guest company reports $648,500 of net income for 2011, declares $102,500 cash dividend in its preferred stock of 2011, and at the end of 2011, the company had 260,000 weighted average shares of common stock. What amount of net income is available to common shareholders? What is the company's basic earnings per share? EPS. All right. So in this case, is the net income so is 648, 500, less preferred dividends, of 102, 500. That gives a balance of 546, and that's the net income available to common stock. We divide that by the weighted average, the number of shares outstanding. That means the earnings per share is 210. Okay, so when you see EPS touted on these financial shows, that's what they're referring to. Okay, so it's the net income less what's due the preferred stockholders. That, so you take it out, what's left over is what's available to the common stockholders, divided by the number of shares. That gives you your basic. Next ratio we're going to take a look at is the price to earnings ratio, the PE ratio. Okay, so the PE ratio basically, it's the market value per share divided by the earnings per share. Okay. It equals the market value per share divided by the earnings per share. Okay. So let's do exercise 13, 15, and you find that on page 540. Now, by the way, let me kind of back up here a bit. What this tells you is how optimistic investors are about the future of the company. Okay? So if the PE ratio is 20 and above, then it's seen as overly optimistic. If it's between 8 and 10, then it's seen as undervalued. Okay? And again, if you guys are all right, you ready for the next one? So the next one is the dividend yield. The dividend yield is the annual cash dividends per share divided by the market value per share. Now in this case, what this is saying is, suppose you're retired and you invest in the stock market and one of your main interests is getting cash flow to live on. So you look at this as a return on your investment. Am I getting a good return on my investment? And of course, the risk comes into play. You're saying with the same level of risk, could I get a better return elsewhere? And of course, every company has a risk. If you could get the same thing by investing in a money market or even put a savings account, they would be a better choice because they'd be less risky. But it's looking at as a return on the investment, and a retired person being interested in that. All right, now, the next one is the book value per share, and Tim, this is kind of tiny to what you had. It'll be this, or was it Michael? Somebody had it. It was Tim, all right. So basically with this one, what it is this book value per share. All right, book value per share. And this is common share. It equals the stockholders' equity applicable to common shares divided by the number of common shares outstanding. Okay, now why don't I do, let's do exercise, in this case 1316, find that on page 540. Why don't I do numbers 1 and 2, okay? 540, here it is, and it's 1316. And I'll put this here, so here's 1316. And here's that, you guys are still working with it. And basically what it says is, 1360. The equity section of the Webster Corporation's balance sheet shows the following. Preferred stock 5% cumulative, $10 par, $15 call price, 10,000 shares issued and outstanding, $100,000. Common stock, $10 par, 5,000 shares issued and outstanding, $50,000. Retained earnings, $267,500. Total stockholders' equity, $917,500. Determine the back value per share of the preferred and common stock under the two separate sections. No preferred dividends are in arrears. 3 years of preferred dividends are in arrears. Okay?